Welcome to this explainer. Ever wonder why some top-tier funds are suddenly getting downgraded? Let's dig in.
For new investors, it's pretty shocking. A fund with stellar managers can absolutely still be a bad investment.
The sneaky culprit? The expense ratio. Simply put, it's the annual price tag you pay to invest.
A strict new rating system is actively downgrading pricey funds, even if their core fundamentals are basically bulletproof.
Take our first example, the Invesco Asia Pacific Equity Fund. They have really strong management, but
They charge a glaringly high expense ratio of 1.43%. Honestly, that's a massive anchor dragging them down.
Because of that hefty price tag, it dropped to neutral, completely overshadowing its otherwise great management.
So is this just an isolated case? No way. Let's look at GQG Partners Emerging Markets Equity.
this one carries an expense ratio of 1.18%, which is slightly above average for its category.
The crazy part? It dropped from gold to silver, despite having highly rated people and processes.
Even experts who personally own this fund and love the manager admit that these fees just gotta drop.
This harsh penalty hits small caps too. Our third example is the Barron Small Cap Fund.
They charge a rather pricey 1.32% expense ratio for their specific market category.
Once again, high fees brutally dragged it down to bronze, totally ignoring its high process ratings.
Turns out, it's a family affair. Our fourth example, the Barron Asset Fund, follows the exact same pattern.
It holds a nearly identical expense ratio of 1.31%. That's just way too expensive today.
This perfectly illustrates the trend. A great process absolutely couldn't save it from dropping to bronze.
So we've seen 4 great funds penalized for being too pricey. How do you protect your wallet?
Here's a practical tip. Before buying, always find the expense ratio and verify it's actually competitive.
A great manager is totally useless if fees eat your returns. Are you unknowingly overpaying for your portfolio?